Hello, I hope this finds you well. Today is Friday, March 16th, 2018, and in just under 5 minutes, I will answer the question, is a recession coming soon? It's been a while since I've talked about the 5 indicators on a video, and since the bull market just recently turned 9 years old on March 9th, and it's now the second longest bull market post-World War II, I thought it would be a good time to give you an update on where these indicators stand. But first, let me remind you what they are. Although every economic cycle is unique, LPL Research put these 5 indicators together to help capture a complete view of the economic and market environment. Now, the indicators are meant to be considered collectively, not individually, and historically can signal the transition to the later stages of an economic cycle and increased potential of an oncoming recession and bear or down market. Here are the 5 indicators. Number 1, the Treasury yield curve. Number 2, the Index of Leading Economic Indicators, or LEI. Number 3, market breadth. Number 4, Purchasing Managers Sentiment, or PMI. And lastly, number 5, market valuation. Now I'll go through each of these individually. First, the Treasury yield curve is showing no warning. Bull markets have historically ended when the Fed pushes short-term rates above long-term rates, which is called inverting the yield curve. And this indicator is considered one of the most reliable because every recession over the past 50 years has been preceded by the Fed hiking rates enough to invert the yield curve, and that's 7 out of 7 times. Now, if the 10-year Treasury stays around what it's currently yielding, which is about 2.9%, the Fed would have to hike roughly 7 times to invert the yield curve by 0.5%. So we're talking about 2 years away, assuming the Fed hikes rates by 1/4% each time. Second, the LEI is showing no warning. This indicator is also considered reliable at providing early warnings of recessions and bear markets. When the year-over-year change has turned from positive to negative, a recession has typically followed within 14 months. The latest reading for January 2018 rose 6.2% over the past 12 months, signaling a low probability that a recession will cause a bear market in the next year. Third, market breadth is showing no warning. Market breadth, which is measured by the number of stocks advancing versus declining, gives us a sense of how broad and durable a market rally may be. Think of the late 1990s when the tech sector was the only sector holding the market up. Currently, the NYSE Composite Advanced Decline line shows no major warning signs, another way of saying the rally is broad-based. Fourth, ISM's PMI is showing no warning. This index shows demand for manufactured goods and has historically been a good earnings indicator. As earnings are the most fundamental driver of the stock market, this index can show when economic activity may be slowing. The February reading of 60.8 was the highest since 2004 and significantly above 50, which is the level that indicates contraction. The fifth and last indicator is stock valuations, or how expensive stocks are, which is the only of the 5 indicators on watch. It's important to note this indicator has been on watch for a while now, and also that stock valuations have not historically been effective short or intermediate investment timing tools. That said, the PE ratio, which measures the price paid for a share of a stock relative to the annual profit earned by that company, may be able to tell us when the stock market may be more vulnerable to deterioration in the economic cycle. The S&P 500's trailing PE ratio is now around 20, down from 23 at the S&P 500 peak on January 26th of 2018. In conclusion, despite the bull market's old age, broadly, these indicators give us confidence that we may be celebrating the 10th birthday of the bull market 1 year from now. Thank you for taking the time to watch this as always, and if you have any questions, please feel free to reach out.